One of the most important macro signals just flashed again. The yield curve is steepened by almost a full percentage point in 2025, coming out from one of the deepest inversions in modern financial history. The last time we saw this exact pattern was in 2019, in 2007, and in 2001, and in each of those cases, a recession followed shortly after. In fact, going back to the 1970s, a steepening yield curve is a perfect 6 out of 6 track record of predicting an economic recession. Yet today, a year after the signal first appeared, the economy still looks strong. US GDP grew by 4.3% last quarter, and the stock market is still hovering at all-time highs. Many are now arguing that this notorious recession signal is no longer relevant and has broken its perfect track record for the first time in 5 decades. But first, a very brief rundown on what the yield curve is meant to be and why a steepening is meant to coincide with a recession. The yield curve takes longer-term bond yields, like the one you get on a 10-year Treasury bond, and shorter-term bond yields, like the one you get on the 3-month Treasury bond, and it looks at the difference between them. This is what it looks like. This is the yield on a 10-year note minus the one on a 3-month note. Now, most of the time you have the 10-year yield that is higher than the 3-month yield, so the yield curve is positive. You get paid more for locking your money up longer. But when the Fed pushes short-term rates high enough, the curve inverts and its assigned policy has become restrictive. Borrowing becomes expensive, credit slows, and eventually economic growth weakens. Then, as a recession approaches, the curve usually steepens again because the Fed begins cutting short-term rates in response to rising economic stress. And indeed, today we are also seeing signs of economic stress. This chart shows the yearly change in leading economic index. It combines forward-looking data, things like credit conditions, building permits, and new manufacturing orders, to give us a sense of where the economy is heading. And right now, it's been sitting in negative territory for a couple of years. That tells us economic momentum is already slowing beneath the surface. If we zoom out, periods where the index drops into negative territory also tend to be followed by periods of economic recession.